Welcome to Hedge Fund Tips with Tom Hayes. This is for the week ending October 16th, 2020. This is our 52nd VideoCast and our podcast episode 42. You are in the right place, Hedge Fund Tips with Tom Hayes. So let's get rolling here. We'll start with our media spots. This week we want to thank Devik Jain for putting me in his Reuters article. I guess the question was on a day we were down about stimulus talks. My quote was, the market's a little bit worried about not having the extra support for the next couple of months into the holidays for consumer spending was what I was referring to. And this was viewed, the package, as a bridge to a full therapeutic or vaccine, but everything's getting delayed without the stimulus. There's not that short-term bridge that we needed to get to the vaccine to get us to the finish line. So, I think I'm certainly in the camp of Larry Kudlow. We don't need a stimulus package for the recovery, but there are a lot of people out there still hurting that lost their jobs to no fault of their own. And my general view is if the government shut down their business or the businesses they work for, they should be made whole. And that's what it's all about. I've been in the camp that maybe President Trump could do some type of executive order. There is some precedent since we have $300 billion left over. We're going to find out in coming days. There's still a lot of dialogue about getting a stimulus package before the election. We'll see. Stranger things have happened. I think the pressure is really coming down on both sides. Sitting in Washington collecting their checks, sometimes they forget how many people are not collecting an employment check, and maybe they'll get a move on. So we're going to talk a lot about that this week. Thank you again to Devik Jain for including me. And let's move right along because we've got quite a bit to cover and quite a lot of exciting stuff to cover this week. I want to point out this one article. Usually we'd cover this later in the podcast, VideoCast, but Sean Langlois, who's covered me in a number of his articles, he put out a really cool article this week called Buy the Worst ? Here are 5 destroyed stocks for this bottom fishing strategy. And if you've been with me for a while, you can kind of tell I don't like to buy things that are expensive. I tend to buy things that are cheap and sell when they're dear. But he actually looked back on an article from 2012 that laid out the 5 best and 5 worst performing stocks in the S&P 500. This is kind of like the old dogs of the Dow strategy, which does outperform over time. But this is for the S&P. And there was an article, I guess, published at the last day of 2012, which said the biggest winners for 2012 were Pulte Home, Sprint, Whirlpool, Expedia, Bank of America, and the biggest losers were Radio Shack, SuperValue, AMD, Best Buy, and Apollo Group. So the strategy was to buy the 5 losers. Now, if you realize Radio Shack went bankrupt, I think maybe SuperValue did also. So not all these 5 worked. But what was the difference? If you'd bought the 5 stocks that performed the best in 2012 versus the 5 stocks that performed the worst, how did it turn out? Well, if you bought the winners, you did okay. Between 2012 and today, you made 250% gain, which was, if you put in 1,000, that's not a 250% gain. That's 150%. He says 1,000 became 2,500. Anyway, so that was a great return, and so turning 1,000 into 2,500 with the 5 best. Now, if you bought the 5 worst stocks in the S&P 500, that same 1,000, rather than growing to 2,500, would have grown to $9,000. So more than 3 times the outperformance, 3 times the return, 9x return. And so his takeaway is you shouldn't overlook bad stocks. Of course, do your due diligence and definitely don't invest all your eggs there. But conversely, don't ignore stocks just because someone tells you to. And this was a great case because it's not like it was some random year where the bad ones just did well. 2 of them, I think, went bankrupt. And even so, you wound up with 9x versus 2.5x, which is pretty phenomenal. So great note by Sean Langlois. And that's kind of thematic for some of the stuff we're going to be talking about today. Now, we're going to move right into the article of the week here. And the title was the quote, "I'm an accountant, stock market, and sentiment results." And this is a funny little clip from TikTok. It's been trending. It's about a struggling actor who gets tired of telling people at parties when they ask what he does, instead of saying, auditioning is a full-time job. He now just tells people, "I'm an accountant. I work at places where accountants work," and no one asks questions of accountants. And I use that because, the first thing you saw with the talking heads, they've been obviously beating the hell out of the banks for the last couple of months and talking them down. And, they've generally, as a group, they've gone sideways. Some have gone down, some have gone up. But by and large, they've done nothing since the initial crash in March and April. And some of them are starting to perk up. But the basis was the markets were down for a few days when the big four banks were reporting on Tuesday and Wednesday, and they interpreted that as the earnings must have been terrible, and therefore banks are terrible, and therefore they're uninvestable, and therefore stay away. But when we actually did some accountant-like things and looked at the facts and the numbers versus opinion or versus what is happening in one day, or people panicking out or selling in despair or final capitulation, or however you want to characterize it, the earnings were actually phenomenal. And the most important part is what we've been talking about for the last 4 weeks, which was reserves are going to come down dramatically, and in coming quarters, they're actually going to be starting to reverse. And that already happened with JP Morgan actually released some reserves, which helped their earnings. But as far as earnings, JP Morgan, Citi, and Bank of America all beat on the bottom line. And Wells missed by 3 cents on the bottom line. We're going to talk about that. As far as revenue goes, all of them beat revenue expectations, including Wells Fargo, crushed revenues expectations. And Bank of America was a little light on revenue expectations. But by and large, in line or beating both on the top line and bottom line for all the four major banks. But the story of this week is the huge drop-off of credit reserves. If you remember last week I was talking about, they made these assumptions. There are two bad things happening. Number one was CECL, the accounting change by FASB, which we're going to talk about, which forced them to take 100% of expected losses all up front for the first time in Q2. The timing couldn't have been any worse. This is the exact same mistake FASB made in 2007, which caused that banking crisis over the next 12 months. And once they reversed that accounting standard in Q1 of 2009, the banks just ripped. They were all up like 100% off the bottom once FASB realized that they screwed up. They still haven't realized they screwed up on CECL, but maybe that's coming. We'll see. But the story is, let's just take a look at the credit reserves. JP Morgan took $10.5 billion last quarter, down to $611 million this quarter. It was actually $1 billion, but $500 million were released, so that helped. Their net credit reserves was $611 million. Citi was down from close to $8 billion last quarter to only $314 million this quarter. Wells Fargo, great story, down from $9.5 billion to $769 million this quarter. That's huge. And Bank of America took the most reserves because they took the least last quarter, $5.1 billion. They were down to $1.4 billion this quarter from $5.1 billion last quarter. So hey, they had the least improvement in reserves, although it was still dramatic. Wells Fargo and JP Morgan were probably the two best on that front. The other thing is they published their book value per share, all of these major banks. And what's interesting, with Wells Fargo trading down to, we're going to look at the chart here in a second, but where did it close here? At $23, a little below $23. the book value per share came down only about $1.50 year on year from last year. So their book value per share is $38.99. It's trading at about $23. So that's got the biggest discount for book. In my view, the biggest opportunity. Bank of America, their book value actually went up. Can you imagine over a pandemic and shutting the world down for 2 months? Wells Fargo basically stayed steady. Bank of America's book value went up. Citi's book value went up $3 a share. It's at $84. The stock is trading much lower than that. And JP Morgan is still trading at a premium to book. They're best in class, but their book value went up a few dollars from 75 to 79. Citi from 81 to 84. Wells Fargo from over $40 to just under $39. And Bank of America from just about $27 to just over $28. So when you look at the intrinsic value over time, and when we initially put out this thesis in late August, we showed that through the 2008 great financial crisis and the 2002 and 2003 recession, despite the fact that the stocks all sold off over 50% like they've done this time, their book value pretty much stayed steady. Their intrinsic value stayed steady through the great financial crisis, through the tech wreck, and it's the same as holding true here. And the same results will happen. They will trade back up to all-time highs over time. And in some cases, Wells Fargo traded as high as 1.75 times book just a couple of years ago, which would make it a $60, $65 stock once euphoria comes back in. I had a client reach out to me. He goes, look, you talk about Wells Fargo so much. It's only 2 or 3% of our portfolio. Why is it such a big deal for you? Why do you spend so much time talking about it? So the reason it's a big deal, so last year we had a monster year, and clients were up between 110 and 128%, depending whether they were cash and margin accounts. And I always have to tell clients, don't expect a repeat of that. Always set expectations low. That was a big year, and but a good portion of those gains came in the fourth quarter of the year. So, for instance, while Wells Fargo is only 2 or 3% of the cash value of the portfolio, that's a pocket of our book that we do derivatives, which controls a notional value, which is larger than the overall portfolio. So, if we were effectively 100% wrong on the position, we would lose 2 or 3% of cash, which is a big loss, but it's not a big deal because it's offset. We had home builders off the lows. We had a lot of good things from March and April. So we'll have a good year. But how you get the monster year and how we were able to get a monster year in 2000 last year, 2019, is because you have these pockets of aggressive positioning. So on a $20 million account, that 2 or 3% can control $40 to $60 million of Wells Fargo stock. So if you're wrong, you're losing 2 to 3% of cash. If you're right, and it moves through that, and you're controlling $40, $60 million on one account, those are the type of moves when you get it right that make triple-digit years. And they don't happen all the time. And it's conceivable that you lose the 2 or 3% and you make it up on other things and have a good year instead of a amazing year. But that's a key reason that we spend a lot of time, and you have to know what you own, and we own some stock on it too as well. But when you have these ideas where there are catalysts in place that could play out, that's where you can take very small pockets and aggressively get notional value. So as a cash value, it's effectively nothing. It's something, but it's not. As a notional value, at 2 or 3 times the notional value of the overall portfolio or the overall account, it can be so meaningful in moving from a nice double-digit year to really an off-the-charts year, and it can happen in weeks, and certainly in a quarter we saw last year, and we may very well see the same thing this year as some of these catalysts work themselves out. So the big weight on the banks, and I want to talk a little bit more about JP Morgan and Wells Fargo as far as their earnings. So JP Morgan's the biggest bank in the country. They made $9.4 billion on the quarter, $2.92 a share EPS. That was an all-time record in the middle of a pandemic. It just goes to show you how strong the underlying economy is. It's not for everyone. Obviously, that's why we need to get stimulus to those people who have been left behind in the front-facing jobs in travel, leisure, hospitality. But the economic machine, the engine is running. So, that's number one. Number two, the loan loss provisions across the board, as I said, were very important. Now, when you look at Wells Fargo, which is, as I like to affectionately call it, the most hated stock in the S&P 500, this is obviously a turnaround story. Charlie Scharf, it's his first year. They gutted everyone who was involved in the accelerated sales scandal in 2008 when the asset cap was put on. The last executive just had his last earnings call this week. So now there's no one left that was involved in the scandals, which gives them strength to go back to the regulators and say, we've cleaned house, we've changed our practices, lift the asset cap. But the other thing you need to know, and Charlie Scharf has done something smart, the reason they were able to only take $769 million of credit provisions is because he kitchen sinked it last quarter by taking $9.53 billion of reserves, unlike Bank of America that seemed to be less conservative. That's why they had to take more. The second thing he did, as he got all his reserves out of the way last quarter, what he did this quarter is he got all the expenses out of the way. So while Wells Fargo earned $2 billion, that's, for the most hated stock in the S&P 500, to still make $2 billion in one quarter in the middle of a pandemic is not too shabby. But that was after taking $2.4 billion of charges, okay? So they paid out almost $1 billion of customer remediation refunds to customers for overcharging accounts. So from that scandal, they just paid out $1 billion, okay? People aren't really talking about that. Second, they paid $718 million for restructuring, which is severance, because remember, they're going to work in $10 billion off their run rate of expenses over the next few quarters. So these are some severance charges that they're going to. Severance is one time. The free cash is recurring. That's huge. And $769 million for credit losses against a war chest. They had over $20 billion of loan loss reserves. Those are going to come back as income and earnings, and I can assure you that is not priced into the stock. There was an analyst out after earnings that upgraded the stock from Argus Research. He goes, why Wells Fargo stock could rise over 50%. And, he talks about the restructuring. He put a $35 price target on the stock. He talks about the net interest margin, which we're going to talk about, and the low rates, etc. But he's basing it on, their 2021 EPS estimate. It's stock trades at a discounted 10 times our 2021 estimate. This is where everyone misses the boat. And this is where people think the stock market is expensive because it's trading at 22 times 2021 earnings. You're making your decision off trough earnings, not off of trend earnings. So once you get the vaccine and all of this business comes back, earnings are going to go up to trend, and the general market is trading at a significant discount. You'll see that multiple come down. In 2009, you saw these stocks trading at 100 times earnings, and you're like, oh, we got to crash more because the stocks, no, the earnings just went to crap for 1 or 2 quarters because of the crisis, just like earnings went to crap for 1 or 2 quarters before because of the pandemic. But when those normalized earnings come back, the multiple is going to be really low. You're going to see the forward multiple drop to 15, 16 times. And then with low rates, and people are going to say stocks are too cheap, and you're going to see a panic in. But that's a next year story. Right now, we got to work through the information vacuum we've talked about for weeks, the vaccine, the earnings, which we're seeing now, 85% beat on the bottom line, 83% beat on the bottom line so far, which is well above the quarterly average. So earnings are coming in very, very strong. And the election we've got to get through. We're going to talk about some statistics around that. And then the stimulus package, whether we get a $300 billion carve out or a full boat thing. I mean, no one's expecting a $2 billion deal. If we actually got that next week, which I put at a low probability, higher probability of $300 billion executive order, we'll see. I'm not sure what they're delaying on that. I think there might be some trepidation. Nancy Pelosi was saying, we're going to look into the 25th Amendment, which is like removing a president. So maybe they're afraid to do an executive order because they'll try and remove him. But there's 200 years of precedent. There's wide public support to get the stimulus out to those who need it. If either of those two things happen, the $300 billion executive order or $2 trillion package, the market's going to just rip higher. I think, they're lower probability. They're not priced in. They're priced in for after the election, which I think is more whimsical than getting it now, because after the election, you don't know what it's going to look like. And then the new people have to come in and figure out where the coffee machine is. And so that could delay it till February or March, which is, going to be hard on the holiday season for consumer spending. So hopefully they'll do something sooner than later. But that was a nice upgrade to $35 after they reported earnings. And the point that I'm making is he's looking at what estimated earnings are today. That does not include any of those $20 billion of loan loss reserves that could be reversed over the next 4 quarters. If a quarter of them are reversed, his estimates could be 100%, 50% too low. So there are a lot of moving parts here, and with expectations so low, the upside is dramatically high as some of these things get worked out. Now, do you have some more pain like the article today that Buffett is still unwinding his position and all that? Number one, you don't know if it's Buffett or if it's his lieutenants, who are the same guys that are buying Snowflake and doing things that Buffett has never done in his career, buy a stock at 200 times sales or 100 times sales. So I wouldn't correlate every single move to Buffett. I would say the Japanese trading companies, that's a Buffett move. They're trading at low valuations. That everyone knew his signature was on. It was, $8 billion deal. The Dominion Energy assets that he did for $10 billion, that has his signature on it. But some of these other moves, it's really unclear who's making the decision. So the other pressure that you saw, obviously, was the net interest income this quarter. And in the case of Wells Fargo, this asset cap, their inability to go beyond a $1.95 trillion loan book, is impairing their earnings power in the short term. So I see that. So while most people see that as bad news, I see that as an upside catalyst that's not priced in. Now, people say, well, how can the stock ever recover if the asset cap isn't lifted? Well, keep in mind, the asset cap went into place in 2018. The stock traded at $55 earlier this year with the asset cap on. So that is just additional whipped cream, but it certainly would be a catalyst straight up to book. I think there are two things, and we're going to talk about Richard Kovacevich, the former CEO of Wells Fargo, was on CNBC right after they reported, and he had some important things to say about that. But real quickly, you could see here how dramatic the change has been from when they were doing their CECL credit reserves in Q2 based on ridiculous outlooks of, 20% unemployment and negative 9% GDP, whereas we're at 7.9% unemployment now and negative 3.5% GDP for 2020. So these loan loss provisions have just dropped off the charts. Jamie Dimon had an interesting quote. He said that a good, well-designed stimulus package will increase the chance of a better outcome if that happens. So what he's saying is, if we get a stimulus package, his bank is over-reserved by $10 billion, which means that comes back as earnings. The question is, does it come back in 2 quarters, in 4 quarters, or in 8 quarters? But either way, if you consider that they earned $9.4 billion on the quarter. That's they're going to get a whole free quarter of earnings back if a stimulus package is passed, and that's no different for Wells Fargo with all the provisions that they have as well. And you see they're just dropping off the charts here for Wells. Now, the other thing that was interesting, so Citi, Michael Corbath said, all else being equal, if the management adjustment had not changed, he talks about ultra-conservative management adjustments as far as the reserves, we would have seen a reserve release of roughly $500 million on the quarter like JP Morgan did. No one other than us, if you look back at our podcast, we're talking about the possibility of reserve releases in the past 2 months. And they already, JP Morgan did it this quarter. Citi would have done it, but they were ultra conservative. They're still taking their worst case scenario. Base case, they say it's probably not true, which means those reserves are going to be coming back as earnings very, very quickly. The Wells Fargo CEO said, over the long term, annual expenses will be reduced by $10 billion lower. That speaks to the efficiency ratio. Theirs is in the 80s. They brought that down about a point and a half this quarter already, but their peers are in the low 60s, and that's all free cash that's going to go back to the owners, the shareholders of the company. The question is, how quickly does the market see it, right? So you can only control, 2 or 3x notional value of your total portfolio with 2 or 3% of cash for a limited period of time for the catalyst to work out. So we'll see. Here's Bank of America. Okay, so you had the outgoing CFO Shrewsbury on with Wilfred Frost on CNBC on the day they reported earnings. And here's what he had to say about the asset cap. Number one, he didn't expect it to last this long, but it's very constructive engagement with the regulators. Everything that needs to be done is being done to get the asset cap removed. He says that his sense is that the company will get through it. And it's a different team today operating across the board on issues that have to be improved for the asset cap to go away. So he's basically saying, okay, bad actors, aggressive sales practices, wrong incentives, government punishes us on that basis. Well, now, different incentives, different management, different practices. Why is our cap still on? It shouldn't be on. And I think that the government is going to figure out very quickly you can't handicap one of the top lenders in the country and expect the recovery to continue. You don't get a sustainable recovery without credit expansion, and anyone who's been around more than 5 minutes knows that there is no recovery without banks recovering. So if you take care of the banks, you take care of Main Street. That's really how it comes, because they're the credit transmission mechanism. Okay, then there was such an important call. They didn't even post it, as far as I could see, on the CNBC website. Fortunately, I got it with my mobile phone, so it's not the best quality, but you can watch it at hedgefundtips.com. And Richard Kovacevich was talking to Melissa Lee and David Faber. He made like the most important points I've heard. First off, he said that he believes Wells Fargo is working primarily, first priority, on fixing the issues they have with the Federal Reserve to remove the asset cap. If that comes off, that's $10 immediately, overnight in the stock. That's $10 immediately. I think the vaccine, which Pfizer came out today and said they're going to apply for emergency approval in mid to late November. I think once that's actually approved, you're going to see another $8 to $10 for banks for Wells Fargo. I think those are really the two key things. And it really was Richard Kovacevich that got me clear on this. He said the vaccine is the most important catalyst. So he said, number one, he's still a shareholder. He thinks the turnaround is going to come. The other critically important part, which I wouldn't be bold enough to make a call on, although we're seeing it in the 210 spread, he believes that the net interest margin, which has been the source of their earnings weakness, it may have reached bottom here. Okay, that's his gut from a guy that's a legend in the banking business. I'm going to take that at face value. That's probably a pretty good call. He said the vaccine is the most important catalyst for bank stocks, as certainty equals economic turnaround equals more employment equals loan growth. Couldn't agree more. And then he went on to bash CECL. And if you've listened to me for the last couple of months, I've been talking about CECL like crazy and saying that they were over-reserved and they were going to have to release reserves. But this really stuck out. So, as I said, it's an accounting change that requires banks to take 100% of expected losses as reserves up front. And here's what Dick said, absolutely makes no sense, increases the cyclicality of the banking industry rather than reducing it, which is the intent. Their intent was to reduce the cyclicality. They did the opposite effect, unintended consequence. And the FASB is making a very big mistake by forcing the accounting change on the banks at any time, but particularly at this time of uncertainty. And they made the same schmucky mistake in November 15th, 2017, and crashed the economy and crashed the banks over the next 12 months. And you know when the economy and the banks turned around? In first quarter of 2019, when they reversed their mark-to-market FAS 157, and the banks doubled overnight. And once the banks doubled, they started lending, the economy came back, everything came back all at once. Maybe they'll wake up and temporarily suspend it for the next 8 quarters until the economy is back to pre-COVID GDP levels, and then rethink it and scrap it all together if they're really smart. It made no sense to do. It should be looked at on a quarter-by-quarter basis as conditions change. Taking 100% of reserves when estimates are 20% unemployment, it's insanity. So, long story short, I couldn't agree with Dick more. He made critically important points. And if that was ever reversed, that's another $10 a share. I mean, you can't handicap what bureaucrats are going to do. But that would be something, that would be a game changer for the economic recovery. You want to talk about V, it would be an exclamation point with a pogo stick. That's what would happen if they figured that out. So that's that. Okay, so the point I made was FASB accounting change was instrumental in causing the great financial crisis of 2008 and also instrumental in reversing it in Q1 of 2009 when they reversed their mistake. And perhaps they'll wake up and do it this time. Okay, what has changed as it relates to the Wells Fargo thesis? Has anything changed since we saw earnings? Well, the yield curve has gotten better. We pointed out the last 2 crises in 2008 and in 2003. The green is financials here, and the white and red is the 210 spread. As this steepens, the financials bottomed and it started to recover. We've had the steepening. Everyone's looking at short rates, but if you look at the spread, it's getting better. And sure enough, we're seeing the beginnings of the recovery, but I think this is really just the beginning. Despite the emotional capitulation selling this week, it still held this long-term support where all the volume by price is located. So nothing's really changed here. We just need one of these catalysts to kick in, whether it's stimulus, vaccine, CECL wakes up and gets their head out of the sand, rather FASB does, or just all the sellers are out, which may have very well been the case this week. So we're going to find out. The Cobra Kai leg sweep from 2 weeks ago. So we talked about this leg sweep, capitulation selling. It actually held that level this week. It's gone a little bit lower here. So we're kind of, we're white knuckling it here. That's life. That's where you get paid. So it hit 2. So this was the leg sweep in May before you had that cyclical rotation on good news about the recovery. The other headwind we have is shutdowns in Europe now with COVID. And, some schools shutting down. Every time that happens, money comes out of cyclicals. It goes back into tech because everyone thinks that the shutdowns are going to be forever. Everyone bets against science. We'll never have a cure. We'll never have a vaccine. They all go into their caves and cry the night away. The point is, don't bet against science because, we saw what happened to President Trump with the Regeneron thing. Obviously, as the CEO of Regeneron said, that's a patient of one. But, there are things happening here, and it's just a question of when it's going to be widely available, whether it's that, the WHO, which has been right about absolutely nothing in the last 20 years, came out and said remdesivir doesn't work when there are multiple studies that have proven that it does. It takes the duration of the illness from 13 days down to 6. The Regeneron took it from 13 to 5. They're working on a breathable version of remdesivir, which would be an absolute game changer because it means you don't have to go to the hospital for 5 days to get it injected, which would bring the cost down, which means if you go to a baseball game and you get COVID, you go to the doctor and they write you a script and you go to Walgreens and you pick it up and it looks like an asthma inhaler and you just spray it for 3 days in a row. It's like taking a Z-Pack, only it's easier. You don't even have to swallow pills. You just inhale it 3 times and you'd be off to the races. Now, so that's what we're hoping for. It's only in phase 1, but we know the underlying drug from the state studies that were not done by the WHO, which, by the way, there's well, let's just leave it at that. I like the studies that are done in the U.S. better. So let's hope for that. That's number 1. Number 2, there have been a lot of notices about work being done on breathable vaccines, which would probably bring the vaccination rate up by double if they made it that easy to administer. So here we are. We had the big sweep, and then the stock moved up 51% in the next 29 days. And then you had some shutdowns, and money moved out of cyclicals, and it came down, and it's been going sideways ever since. And then the same thing here after earnings. It held 22.75. I'm sure they'll take that out just to scare people out before taking it back up. But that's where we are. There's no real change. The thesis is still intact. I think earnings were much better than could have been anticipated. You had the stimulus headwinds. You had the general market. You had the shutdowns. And you had a lot of, the J&J vaccine got paused, although they say they're going to have millions of dosage ready by the end of the year. The Lilly treatment that was supposedly going to be like the Regeneron treatment got paused. Pfizer, though, is doing better. Pfizer's going for the emergency approval by mid-November, so that's a positive. But you had all these headwinds of no stimulus, shutdowns in Europe, or curfews in France. Drug pauses, vaccine pauses. One good vaccine news today. Obviously, the market was up a little bit because of that. So all the things that would take money out of cyclicals. So it wasn't just earnings. Because if you look at earnings objectively, like we just walked through, they were way better than anyone could have anticipated. And I think as the dust settles and we get closer to some resolution on the information vacuum, vaccine, earnings are great. By the way, we're going to cover that. The election and the stimulus, we'll know how quickly money's going to go back into cyclicals. The other thing to keep in mind on banks, 60% of the first stimulus checks were used for savings or paying down debt. Only 40% was used for spending. So that directly benefits banks. If we got another $300 billion in checks, call it $180 billion would go straight to banks paying down debt, so they'd have to release those reserves. And as we've seen, the deposits have been through the roof. The other thing about banks, the reserve requirement for banks was reduced from 10% down to 0% this spring. So banks have every incentive to extend unlimited loans. What's handicapped them from doing that is CECL, the stupid accounting change, and the uncertainty in Q2, but now they have more incentive. And in the case of Wells Fargo, the asset cap, which needs to be removed if they want the country to recover sustainably and not have to, borrow another $3 billion in treasuries in order to finance more stimulus payments because they've handicapped their major bank that could have done the credit transmission mechanism for them. Anyway, so hopefully they'll figure all this out, or someone will pass along my podcast and VideoCast, and maybe that will be helpful for a lot of people. Next, tens of billions of loan loss reserves will be coming back to the banks as earnings. This is not priced in. We covered that. Wells Fargo, huge amount of reserves. We covered that. And as Dick Kovacevich said, the vaccine is the catalyst for everything, or some type of silver bullet treatment. If Regeneron turns out to be that would be great, but we won't know that for a little while. So vaccine we'll probably know sooner. And then the last point I made was the same folks selling the bottom. Remember, this was after earnings. They were all selling that day. selling the bottom in despair today will be the same people buying them up 75 to 100% in euphoria, 6 to 12 months out, maybe 18 months out. And that's just the way it always works. So, the other thing is there's no right way. There's some people that'll buy it up 100% and make another 100% buying the breakout, and they just like to do it that way. And like I said last week, there's many ways to the top of the mountain. Some people have the stomach. They want to sit and they want to wait for it to form the bottom. They make the first 100% and the second 100%. And that's just another way to do it. So different strokes for different folks. There's no better way. You just have to do the one that suits your personality the best. And for me, I've always liked to know what I own, buy high quality when it's at a period of dislocation, sit through the gut-wrenching things and make doubles and triples and quadruples over time. And if you can do it when there are imminent catalysts with a little bit of leverage where you get massive notional value for very small risk, that's how you can really have off the chart years and quarters and so on. So the other thing is the Bank of America Global Fund Managers survey came out on Tuesday. They interviewed 200 managers running over $600 billion. Now, here were the key takeaways. And there were a lot of things that were covered, but the key takeaways, and you can just click here to view it. If you are listening to the podcast, go to hedgefundtips.com. Down the right side, click look at most popular articles, and you'll see I'm an accountant stock market. Click there, and then you'll see the link within the article, October Bank of America Global Fund Manager Survey results. So the key takeaways were the cyclical rotation that began in September. If you remember, we were pounding the table that, industrials, financials, transports, the cyclical sectors dramatically outperformed tech and growth in the month of September. That paused in early October as you had shutdowns and uncertainty about stimulus and vaccines. But what they're saying, Michael Hartnett is saying that banks and energy will participate and lead in the fourth quarter. Money's going to go back into that. That's going to be continuation. So it was the start of a new trend. It took a pause. It's going to resume in a material way. 39% of investors expect a credible COVID vaccine to be announced in the first quarter. I think it'll come sooner. And they pointed out by sectors where was max despair. Max despair was in energy and banks. That was the contrarian trade. And that's where we're focusing and spending all of our time. So that was a nice edification of what we've been talking about and what we've been doing with a view 6, 12, 24 months out. Now, investors lowered their cash levels from 4.8 to 4.4. That's not an extreme. Below 4% equals greed, which means this could have some more room. What is an extreme, with this stood out, because if you remember in February, I believe it was February, when the US dollar was still strong as hell, there was an extreme in bullishness. There was a extreme view that the dollar was overvalued, and the last time that extreme had been that high was the early 2000s when the dollar fell materially. It fell I think it was 40% over the next 12 months. And sure enough, the dollar has rolled over since that extreme. Well, here's another extreme. Energy is now the largest short in 20 years. And I put this chart out of what happened next. It was right in the 2002-2003 recession. And this began a 3 to 5 year global commodity cycle, which is consistent with moderate inflation coming back with $12 trillion of fiscal stimulus. I think we're at the cusp of a 3 to 5 year commodity cycle. I think emerging markets will benefit. I think commodities are going to benefit. And I do think energy is going to have a last run. And, it's not some view of climate change or not climate change. It's just as we need all the renewables we can possibly get just to support the emerging market population and growth, energy demand, and mobility out of poverty. The demand for energy is going to dramatically increase as more and more people enter the middle class. So it's not what's happening in the developed world that tells this story. It's what's happening in the developing world and the demand that's going to persist for the next 20 years. So I think we're setting up here with the dollar, with potential inflation, with a number of factors that buying the highest quality energy here with a long-term view and a strong gut in the short term can have a material impact. And we covered last week what Carl Icahn said and others. Okay, so now on to the shorter-term view for the general market. Everything was mid-range here. Bullish percent was 34. Really, you need that over 40 before you get worried about lightening up. Fear and greed was 55. That's mid-range. And the active manager started buying, but that was only at 73%. I think it's actually jumped since, so we may have to keep an eye on it. My message for the week was don't bet against science. And I've said that consistently for the last 2 months. We saw Trump's recovery. There are other treatments out there that are working exceptionally well. And we're going to wake up one morning with a vaccine. And then the whole game is going to change overnight. And you don't want to be caught flat-footed into that. Whether that's a week from now, before the election, 4 weeks after, 8 weeks after, what's the difference in the scheme of things? If you take a 12 to 24 month outlook, it's not a big deal. Okay, so in the meantime, so I said expect short-term volatility with the uncertainty before the election, etc. In the meantime, we're adding marginally to our core bank positions and selectively picking up the highest quality energy names on weakness with a 12 to 36 month view. Why? Because we did quote the accounting tied back to the song of the week, and the numbers make sense with a reasonable time horizon and a strong gut. So that is that. Okay, moving on. Let's just see if there's anything that we need to point out on the... Oh, by the way, 61% of the managers in the global fund managers think that the election is going to be contested. That will add more uncertainty. I think that's probably a lower probability than people think. Here's when they think the vaccine will be announced. There are a decent number of people that, less than last month, by the way, which is why the cyclical rotation stalled. Last month, 33% believed we'd have it in Q4 of 2020. That dropped down to about 23% this quarter, and that's why you saw the cyclical stall. So the whole trigger, as Dick Kovacevich said, is the vaccine for banks and for cyclicals. We talked net equity exposures picking up, and that was that. The most crowded trade is still long U.S. tech for the 6th straight month. And the biggest risk is COVID, and that followed by the election, followed by the tech bubble. So those are the three things people are worried about. The COVID worry picked up a little bit in the last month survey. The other thing that I was talking about with regards to Charlie Scharf, kitchen sink quartering, the profit slumped, but no one was talking about the magnitude of the severance and the remediation charges, which we covered. That was covered in this article. JP Morgan, we covered. Diamond signals the all clear. JP Morgan earnings smash expectations as loan loss provisions plummet 94%. And it was the same case with Wells and Citi taking the loan loss reserves down over 90%. Huge thing. Okay, deposits at JPM up 30%. The return on equity was 29% in the middle of a pandemic. It just goes to show these big four banks, when they're hitting on all cylinders, are just going to shoot the lights out for sure. So the other thing that's interesting, so here we are, for instance, Wells Fargo and Citi really haven't dropped this much this quickly since the great financial crisis in 2008, 2009, the last time FASB screwed up. And this article was, here's how much investing $1,000 of Bank of America at Great Recession lows would be worth today. And they go through this whole thing that people were worried about the loan losses and all the mortgage foreclosures and everything else. But if you just, sucked it up and had a strong gut and you put $1,000 in, it would be worth $7,453 today. Now that's today. It's down 33%. So it'd probably be $10,000 as of pre-COVID. So 10x return in 10 years is not that bad. And I think you're going to see similar type of results with some of the really overbeaten down banks over the next 10 years that no one wants to touch with the 10-foot pole. Some people are just going to flip them for 2x or 3x over the next couple of years, but some people will hold them, and you could certainly see some of these banks at 9 or 10x with just like we saw with Bank of America for those who had the courage to buy it when no one else wanted it. And remember, people were talking about the banks being nationalized and all the other different things, and they took money from the government. It was much worse then than it is now. And their recovery in terms of their economic numbers were not nearly as quick as what we're seeing now as well. So it's just something to keep in mind. It reminds me of the Bottom Fishers article by Sean, taking the 5 stocks that no one wants. You made 9x versus the ones that everyone wanted. You made 2.5x. It's the same thing here. This is going to be a 10x situation. It's a similar outcome. There was a Sign Alert Asset Management put out a note this week regarding energy. It appears that investors are banking on a worst case scenario as the Energy Select sector spider, I guess that's the XLE, is still down almost 50% for the year. Since the introduction at the end of 1998, the Energy Select Fund has never been cheaper compared to the S&P 500 index. Moreover, the book value to price ratio of the fund is 1.1 times, which means that the sector's valuation is slightly above the total asset value if all assets on component companies' balance sheets are liquidated. This ratio is at its lowest since 1986. So, unless you are certain that nuclear fusion is going to be launched tomorrow and we're going to have no need for fossil fuels ever again, buying at these prices gives you a large margin of safety, even if they phase out over the next 30 years. And you're just treating it like a runoff business. It can, the cigarette business, by the way, which is a runoff business, has been one of the largest outperformers of the last couple of decades. If you bought, there was another article on Philip Morris. It was some ridiculous, like 10,000% return owning cigarettes, which was a runoff business. After, less and less people are smoking in the developed world. Guess what happened in the developing world? And it's the same thing with energy demand. But you can't sell that story right now. It'll just happen. By the way, we had a huge draw this week, as expected again. And that's going to catch up with us. No major investment for 5 years. It will catch up. You will wake up. Oil will be at $60, $70 a barrel, and everyone will say, what happened? So, okay. Now Goldman really stuck their neck out this week and not only got, bullish on, the integrated large cap, mega cap energy companies. They actually went down the bottom of the barrel and went to oil field services, bullish on oil field services. Talk about a ballsy move. And I agree. I mean, you got to go the highest quality because, again, 20-25% are going to go bankrupt. But this analyst, Angie Sedita from Goldman, said the sector is still down 35 to 40% from its June highs. We believe the pullback offers investors an attractive entry. Quality companies with appealing 12-month catalysts have sold off by 20 to 50%. In our view, the long-term positive macro thesis for an oil recovery in the second half of 2021 remains intact, and the sector offers opportunity for substantial upside in 2021. Additionally, the often seen seasonal trade of the sector rallying into the end of year post-election and the early in the year lies ahead. So there's some seasonality that's coming into favor now, and that's why we've been getting exposure. Thesis is also predicated on a vaccine, which means travel demand will come back aggressively. And even without a vaccine, we're seeing globally that come back. So they have a few names: Baker Hughes, Halliburton, National Oil, Varco. You can even buy the ETF, XES, or OIH that has all these names. Schlumberger today sold off on earnings. I think that was an opportunity to pick it up for the long term, kind of best in class. Goldman also upgraded Exxon this week. The dividend is still a concern. Goldman Sachs upgraded it anyway. So they think the dividend is intact. I think that doesn't even matter. I think you can buy best in class. And as the 20-25% of the bottom end go bankrupt, they're just going to pick up share. So do you have the gut? And in the meantime, in the short term, you'll have a 10% dividend to collect. Maybe it gets cut to a 5% dividend. What's the 10-year paying? 75 basis points? Give me a break. If you liquidated the company tomorrow, you'd probably get $60 a share instead of 40. And in the meantime, you're paid 10 or worst case 5% to wait. Okay, Walgreens is another value stock that's been beat to hell, and they crushed earnings. It was up, I think, 4% on the day, and that's going to continue. Their prescription business did well. The front of the store is still weak, but this may have turned the corner, and things are picking up in the UK where they got smashed with Boots Alliance. So that was good news on Wells Fargo. On Walgreens Boots Alliance. I wake up in the middle of the night and say Wells Fargo. Anyway, okay. So Morningstar, which I think they've got a good analyst group over there on individual stocks. They're kind of like, they're always at the Buffett annual meeting. They got a good group out there, and I like the way they think about economic moats, and they have a solid framework for how they look at companies. So they're bullish on these value stocks, and I agree with all of them, to be honest with you. ExxonMobil, they have a buy rating and a $74 fair value estimate on the stock. So that would imply, 75% upside from here. Philip Morris pays a 6.1% dividend. They've got a $98 fair value on that. I agree with that. Wells Fargo, they have a $46 fair value on that. So, a little bit above book. I agree with that wholeheartedly. CVS, which is the same story as Walgreens Boots. We have some Walgreens Boots, which we like. And they put a $92 fair value on CVS. Simon Property, the highest end. Yeah, a lot of malls are going to go bankrupt, not theirs. And they've got a $152 fair value. ConocoPhillips, they've got a $64 fair value. I like that. And Kinder Morgan. I mean, the owner, Richard Kinder, has been buying the stuff hand over fist for the last year and a half, 2 years. And they've got a $21 fair value. It yields an 8% dividend while you wait. That's a midstream company. I think these are all great. I think this is kind of like Sean Langlois's Market Watch article. These have all gotten smashed this year. If you bought these 5, 6, 7 stocks, and for like 20% of your portfolio and 80% you just indexed, you'd outperform over the next 12 to 24 months. Speaking of which, John sent me Ask Me Anything. If you're on the podcast, you're going to get cut off in 3 minutes, and we literally have 20 more minutes to cover of great, amazing stuff that, there was so much great stuff out this week. You got to go to hedgefundtips.com, click on the VideoCast, just move it to minute 60 so you don't have to listen to this part again. It's identical. And from minute 60 forward, you'll catch the end of it. But there's a lot. This is not just trail off. Usually it's only 5 minutes. There's probably going to be about a good 10, 15 minutes of really good stuff coming up. So John asked a question. This is the guy who runs the newspaper group in Ohio. Running a hedge fund must be much different than trading a traditional account. However, I would imagine that many of the same principles apply. I have a few questions that may help myself and others as we navigate our way through this market. Do you limit each holding to a certain percentage of the portfolio? If so, what percentage? Okay, so yeah, this is going to be completely different for what I do. I would say if you are, at-home person, I think the number one thing you want to do is just index. The likelihood of your ability to outperform without years of experience is strongly diminished, but that's not to say you shouldn't participate and get some alpha. So I would say you want to have 80-90% in a balanced beta portfolio, which has an S&P index and then whatever exposure you need to fixed income based on your age. Talk with your financial advisor. This is not advice. Click on terms on hedgefundtips.com. Do your own homework, yada, yada. But so I do 80-90% in a balanced portfolio. And then that last 10%, you could get aggressive. So you could have a portfolio of these 7 stocks that I've just talked about from Morningstar. These are great values. Have a 24-month outlook. Collect all the dividends. They've been beaten down. This is a once-in-a-generation opportunity for some of these stocks. And you're going to probably have a blended, 4 or 5% dividend yield. And on balance, that 10% of your portfolio will probably be up 50 to 75% in the next 2 to 3 years. So why wouldn't you have 10 or 15% of your portfolio exposed to some real quality franchise values like this? So I like that. And generally, this might be a little too concentrated in energy. He's got 1, 2, 3 out of 7 names. So that might be too many. So you might want to do like 1 or 2 energy, 1 or 2 banks, and then, one of each of the others, consumer staples, real estate in terms of Simon property, etc. Do you set targets and stops on each holding? In other words, when and why do you exit? Okay, so traders, like day traders, like to have stops because they have to manage the risk. I manage risk by how I size it in the portfolio. So in my case, whether I'm expressing through derivatives, like I talked about in the case of Wells Fargo, I have a huge notional exposure, a very little cash exposure. So I know the most I'm willing to lose in terms of cash and still have a winning year. I think, for instance, if you had 85 to 90% in a balanced beta portfolio, which is basically indexing with ETFs, and you had 10%, you just break it up into equal parts. If you had a higher conviction on one stock, so maybe you'd have 3% in one, and then 1% in 6 or 7 others. So you'd overweight your highest conviction, or 2% in your highest conviction, and kind of break it up into even parts. But I think on balance, the majority of your money you want to have in a balanced, diversified portfolio. As far as your trading or your funny money or your alpha-seeking money, probably equal parts based on conviction, but have enough names, not too many that you're not going to receive alpha. Because if you have 30, you're probably going to do what your index fund is doing for you anyway. If you have 5 or 10 that have been beaten down like this, that are still quality franchises that pay you to wait, that 10% may double over the next, year or 2 years, while the other 90% does, 8 or 10% a year, but that adds materially to your overall return over time. So I hope that helps. As far as do I have stops, it's really based on sizing. I know what I own. I know what the intrinsic value is. So no, I don't put stop loss orders. If the facts change and something's broken, I might sell out of it, but it's very, very unusual. Usually I do the work, my battle is fought before I enter, and any of these short-term emotional dislocations don't really faze me. The question is, do I have cash that I want to add at the margins to bring down my basis? And, is it opportunistic to do so? And does it make me too overweight or whatever? But usually if it goes against me, that's an opportunity because I know what I own and I've done the work and I know where I intend to get out 2 or 3 or 4 years down the road based on my estimates towards trend value, towards a mean range of the multiples that it trades at historically and expected earnings. And I'll look for, closer to the high end of the multiple range based on forward earnings that I anticipate at a normal compounded rate. So naturally, I'm dealing with established franchises that I'm not guessing on, A, if they have no earnings, I don't even play in that game. And B, whether, if it's a high grower, whether they're going to sustain that level or they're going to be a Fazley where the minute they drop off of price to perfection, they drop 30% in a day. I don't play that game. I play with boring state franchises that are dislocated, that will recover and continue to grow at a steady pace over time. It's just I'm getting it at a magnificent discount because it's down 30 to 50% today. And when it recovers back up to fair value, it'll probably trade at a premium to where it traded before the dislocation. And that's when I'll start to look at peeling off and finding a replacement that's currently dislocated, either a sectoral dislocation or a stock dislocation. And they come up all the time. You don't need a pandemic to find that. Every year, different sectors fall out of favor, and that's where the opportunity comes in. Okay, the election. This person, article in Market Watch again, Biden will win, the polls say, but the stock market is sending a different signal. So this derivatives analyst from BTIG said, a rising stock market tends to be a ratification of present policies being satisfying to the investing public. And he said, since 1928, whenever the S&P 500 of the largest U.S. stocks has risen in the 3 months prior to a presidential election, that party controlled the White House, won 90% of the time. So if you think about it intuitively, it makes sense, says Julian Emanuel, Chief Equity and Derivative Strategies for BTIG. Because a rising stock market tends to be a ratification of the present policies being satisfied to the investing public, history lines up squarely behind Emmanuel. In 1928, for example, President Calvin Coolidge, a Republican, chose to retire, but stocks rose between August and November. It was the last full year of the Roaring 2000s and helped lift the new GOP standard bearer, Herbert Hoover, into the White House. 4 years later, the reverse occurred, which began the fall of 1929, dragged stocks down. Between August and November 32, Hoover was crushed by Franklin Delano Roosevelt. In fact, there have been 6 presidential years since 1928 when the S&P 500 fell in the 3 months before Election Day. All 6 times the party in the White House lost. So, this is the exact same thing that Ryan Dietrich over at LPL Financial was saying this week, and he put out the data in a table here. He said a weak dollar and higher stocks bode well for the incumbent party, while the opposite supports the challenging party. So he shows in the 3 months before the election, when the dollar was weaker and stocks were higher, the incumbent won. 1988. Okay. Dollar low. Okay, so here you didn't have a lower dollar. Oh, but you had the opposite. You had a higher dollar and a lower S&P, so they lost. So here, higher dollar, they lost. Okay, so lower dollar and a higher stock market won in 2004. Lower dollar and a higher stock market in 2012 won for Obama. 2016, you had a higher dollar, lower market, lost. And Trump right now has a lower dollar and a higher stock market. It's up, so we don't know. The polls do not imply. However, you know, the joke I said last week, Trump's polls haven't been this low since the night he won the election in 2016. So I don't think the polls are going to tell us everything you see. Again, you know, leaving politics aside, I don't think it matters so long as the corporate tax rate doesn't change. And those who believe the new narrative on the street that if it's a blue sweep, they'll wait to increase taxes because of the pandemic, I think are living in la la land. I think that is going to go up, which is going to bring earnings down. Now, will it be offset by more fiscal stimulus over time? Yeah, but the note that everyone's referring to said that'll take until 2024. So I don't think we'll get a sweep, and that's the most important thing. So whether you get a Democratic or a Republican White House, so long as you have a mixed Congress, one branch Republican, one branch Senate. Obviously, the more likely outcome is Republican Senate. Then you will have gridlock, which means taxes can't go up, which is bullish. So anything's bullish except a sweep that would cause taxes to go up. Right now, based on this data from both of these analysts, anything is possible here. So we just don't know. I mean, the spread on election betting odds, Trump was doing worse at this time against Hillary Clinton, and then you also had in the next week you had that bus incident which really brought him down before the election, and he still pulled it off on an electoral basis, not on a popular basis. So we'll see, and that's why you have uncertainty, and that's why the kind of market doesn't really know what to do. Morningstar, again, they've been putting out some good stuff. They put 33 undervalued stocks for the fourth quarter. Our analysts' top ideas in each sector, and I went through this list. I usually look through these lists and just click delete. I kind of liked pretty much everything they were talking about here. So in materials, they had DuPont, Nutrien I don't know, and SQM I don't really know, but I think DD here probably makes sense for the next 2 years. They had communication service, Fox A is cheap, LUMN I don't know very well, Omnicom, okay. On the consumer cyclical, they've got Macy's, Nordstrom, and Tapestry. I've seen some notes on Tapestry are okay. I think Nordstrom might be interesting, but a little risky. Top picks in consumer defensive, Bud, Coty, or Molson Coors Tap. There was a good note in Barron's on Coty, and, you know, what's not to love about Coors Light? Anyway, that's you know, if you ever find me drinking, it will be with a Coors Light. I just, you know, people laugh at me. I remember my poker buddies would be like, you know, I've never met anyone with a Maserati who drinks Coors Light, but, you know, whatever. Energy sector picks I liked. Enterprise Products, great. Pioneer, great. I'd also look at EOG, and they've got Schlumberger here. They've got a moat on the services side. I agree with that. Financials, they've got AIG, Berkshire, and Truist. All of those are fine. I probably kind of like AIG and Truist a little bit more because of the overexposure of Berkshire to Apple. And that's just my view. We did ride up Berkshire from March and April, but we've recently taken that off. It could certainly go higher, but we had a huge move in it, and we had some derivative exposure, so it was like, at some point you got to pull it off the table. Healthcare sector, they've got BioMarin got recently battered. That might be interesting. CVS, we like Walgreens a little better, but it's the same story. And Anthem, I don't know. Then they've got Anthem might be interesting. I've seen that a couple times. I might want to take a look this weekend. Industrials, they've got Raytheon. We love defense stocks. Any defense stocks we love. So definitely, they've got Herc Holdings or HD Supply Holdings. I've got to look at those. Real estate, Simon Property again. I like that. Technology, Intel, Palo Alto, or VMware. I'd probably take Intel here. I don't really like any of them, to be honest with you right now, but Intel might be interesting with a long-term view. And then they've got some utilities here. Those I'd have to do more work on. But I like the list. Definitely worth looking at. It's all on my website. Just under the search bar, put Morningstar. It'll come up. Okay. Hedge fund short sellers are now targeting the winners from the pandemic. That means some of the vaccine companies, some of the cloud companies, some of the tech companies. This was an article in Financial Times. I thought this was interesting and timely. So you can, Novavax, a couple of these guys are short on. I think there were a couple cloud companies too that ran ahead. HelloFresh, I'm not familiar with that one. I think that's a food delivery company. And they're covering their shorts on some of the other ones like airlines, bricks and mortars, retail, cinema chains. And they're focused on some pockets of technology. So that was interesting. Okay, this was a great article by Bill Smead. He's a deep value guy, runs about $1.6 billion. Good, decent long-term returns, always thoughtful in what he has to say. So he's making this theme like technology could be a disaster waiting to happen because of antitrust. And I think he lays out actually a pretty salient case in the case of Amazon, because Amazon's cloud services subsidize its ability to put all the retailers out of business. So without the profits from cloud, there would be no Amazon Prime that brings stuff to your door in a day at competitive prices. The cloud is so profitable, Amazon Web Services is so profitable. If the antitrust goes through and they deem it a monopoly and they break up the company, on the one hand, shareholders would do well because the sum of the parts, but his base case is that they'd be taxed more because they'd no longer be able to shelter their profits with the losses on the retail side to offset the profits from the cloud side. So they'd have a huge tax bill on AWS, which would make them vulnerable to competitors. And then on the retail side, Walmart would eat their lunch because Walmart's profitable on a standalone basis. These guys are only profitable by being subsidized by the cloud. So if they did get broken up, this thesis is cogent. But the line that I really liked from his note more than anything else was, he said, value has beaten growth by over 3% per year for 94 years and is the most depressed it's been in 57 years. They said in the letter, we look forward to the next 5 years as we believe the remedies will play out. I thought this was really interesting. We spent a lot of time on that last week and showed there were a couple periods of 10 to 15 years where growth outperformed. We're just coming off of one right now, so we'll see if we get that change. I think he's sniffing out the same exact things. And there are cracks in the surface. Very few people go before Congress to talk about antitrust, and life gets better for them over the next 5 years. So we're going to see how that stuff is coming to a head. And if nothing comes out of it, even if they win, it slows them down, like Microsoft missed mobile while they were distracted, and the whole story. So, and then once the antitrust was over, they were able to get back to business, and they've, re-engineered the company, and it's become a huge success again. But during that 10-year period, it was a disaster. Okay. Goldman Sachs calling for a large but temporary rotation out of growth stocks. They say, bond yields are going to rise, which helps financials, and economic growth is going to improve in the next few months. This will trigger the rotation. Upgraded bank stocks to overweight, which is good to see. And that was kind of the crux of their thesis, which helps what we've been talking about and how we're positioning. So good note from Goldman. Next is forget the Biden blue wave and Trump train. Here's the real winner that'll drive stocks. This was UBS. We believe the continued economic recovery from the pandemic will be the dominant driver in 2021. With policy clarity, a new round of stimulus, and a successful vaccine should propel the market in the near term. Aggregate earnings are coming in 23% better than expected, and sales are beating by 5%, very similar to the results in the second quarter. And okay. Short-term volatility will probably continue with uncertainties such as the timing of the vaccine, timing of the stimulus, the election causing market jitters. Bank analysts, unexpected resilience of U.S. corporate profits had given it faith in the recovery of the U.S. economy. Second quarter results that exceeded analysts' expectations by more than 20%, and strong third quarter results from banking giants Citigroup and JP Morgan were encouraging. So that's that. UBS lays out 3 reasons the stock market will continue to rise and breaks down how investors should position their portfolios for the next leg. They're basically talking here about mid caps, emerging market value stocks. I like that, and UK equities, which have been left behind because of the Brexit talks. I think there are opportunities in all of those parts, so that was a pretty good note. And 3 sentiment indicators that are giving off a bullish signal for the consumer and the stock market, according to DataTrack. Number 1, this is interesting. Google search trends of the words Dow Jones. So this Wall Street Main Street indicator is contrarian because when volumes spike by 5 or 10 times in a short period of time, sentiment is bad enough that an investable bottom is nearby. But when the searches start to trail off, it's a sign that consumers' confidence usually rises, according to the note. Following the initial spike among COVID-19 pandemic in February and March, the search interest for Dow Jones remained elevated all the way through early October. But most recent data shows a return to normal complacent levels. This is good news. Second point that was bullish for them was cash levels. Balances remain elevated versus pre-recession levels. This is usually the pattern after an economic shock. And capital invested here tends to only dribble out slowly once investor confidence improves. That's also bullish. And mutual fund and ETF fund flow data, generally positive for equity funds, sluggish for fixed income funds, and negative for commodity funds, according to DataTrack. Money flow data threads the sentiment needle of what Google Trends reveals. General complacency is back. And the money market balance information, cash is still king. Investors slowed up on U.S. equity redemptions, are waiting to see if rates climb, and have lost a bit of their fascination with precious metals. A mixed message, but does not strike us as bearish. So those are the 3 points: cash levels, basically, and the Google searches, which is a proxy for sentiment. So I thought that was a cool extra indicator to put in your quiver. Value stocks could shine after the U.S. election, no matter who wins. So what we've been talking about for 2 months now is starting to become consensus, which is good, because it'll force institutional money flows our way. Okay, every presidential vote in at least the last 40 years has sparked a potential rotation from one part of the market to another, no matter who's elected, according to Citi's head of U.S. equity trading, Alexander Altman. This year, the contest could put value stocks in the limelight after growth shares have surged amid low interest rates and plunging bond yields. Value always performed pretty well in the 6 months after an election, Altman said, adding he has been backing value stocks since the end of May, given the expected shift. The magnitude of that outperformance varies depending on what type of election outcome we get. So he thinks this is a turning point. So that's very interesting to see that post-election data. We saw what the pre-election data usually presages. Now we're seeing what the post-election data. Here's a note on inhaled vaccines, which we covered. Hopefully the inhaled remdesivir as a treatment would be in the works. That treatment, by the way, I looked at it. I looked at that study. You can go to clinicaltrials.gov, remdesivir inhaled, or it says something to that effect. We're supposed to see some data in October. So I wouldn't be shocked after the stupid WHO report today that they come out with some positive data on that in the next week or two, which would be very, very bullish. Now, the day trader high call volume in the tech stocks, which led to the sell-off in tech stocks in September, is back. So there were articles in the Financial Times and in Bloomberg saying that there's a huge amount of this volume coming back into basically FANG, which is pushing them back up. Surging appetite for bullish calls among both retail and institutional traders has been a repeating storyline of 2020. And so it's, the sellers that are short are covering, which pushes it up in the short term, and then it led to the correction once all that short covering buying is gone. And the FT article here talked about Apple. Nearly 4 million options contracts tied to the iPhone maker were purchased on Monday, the second highest level of the year, and amongst the busiest Apple options trading day on record, according to CBOE. Concentrated in calls. The banks that sold the call options were forced to hedge the trades by buying Apple shares, which helped send both the company's stock and overall market higher. The move higher in tech stocks throughout the day was felt across the market. So it's potentially the same story that we saw in late August and early September. Last time it was SoftBank behind it, making multi-billion-dollar option bets on Apple, Netflix, and Facebook. It's unclear from Monday if one institution was behind the surge, but we're going to see if it leads to the same thing where some of these tech stocks. So 490,000 Amazon options traded on Monday, more than 6 times the average daily volume. All of this type of stuff preceded the tech breather we saw in September. So that would actually be a positive for cyclicals. If they start to weaken again, due to the euphoria, then we could see money back into cyclicals and where we're focused. China import-export surge. That's why you saw oil pretty strong this week on balance when the China numbers came out earlier in the week. That's good for the global recovery. Remember, they're about 2 months ahead of us because their epicenter peaked 2 months before our epicenter peaked. Small business confidence at the highest since February. Boeing got the approval for its 737 MAX. That's going to be huge for U.S. earnings in 2021 based on its weight in the S&P. You'll see that come back. No one's talking about that yet. 4 weeks from now, they will be. Pfizer is looking to get the vaccine thing emergency approval mid-November. That would be a catalyst for everything we've been talking about. Earnings, we did a bunch of sectors we caught up this week. This was financials. We just take the top 30 weights. They were revised down 60 basis points in the last 60 days, but next year's went up 1%. So that's financials. They're going to grow at about the same rate as the S&P 500 next year in the mid-20s, which is about double the rate at which tech is going to grow at about 13%. Consumer discretionary was up 6.919% for 2020. 2021 we're up 2.8%, so that was pretty good to see. Staples were up 1.63%, and 2021 up 50 basis points. Industrials were up 4% for 2020. Earnings power in the last 60 days. Exploration and production stocks estimates are flat for 2020. Down 33 basis points for 2021. They jumped 15.8% in the last 60 days. So that's in line with the seasonality and everything we've been talking about for energy. Financials, I think we just did this one. Up 89 basis points for next year. Down 60 basis points for this year. Unusual activity again in banks and energy. This one was Citibank. These are from this week. BP. This is interesting. The bullish percentage indicator we put out a video on this week. This is the level where you get bounces. It got down to 7% of the sector were bullish percent. I think that's those percentage of stocks on point and figure buy. It's just a technical indicator, but I like to look for extremes on everything. And if you look way back at big points of dislocation, it was down at these levels. So we'll see if we get a nice bounce from that. TSA travel, I think, was at about, number one, it's up at one of its highest numbers since the balance. It got up to 984,000 people traveled on October 11th. Yesterday we had 950,000 people, but again, this is still below 40% year on year. And the big problem is the quarantine. So once they remove the 14-day quarantine, because everyone's wearing masks anyway, we don't need the quarantine. These numbers are probably going to shoot up to 60%, 70%. And then if you get a vaccine or treatment, it's probably going to go to 110 or 120 because everyone's itching to do something. So that's a positive sign. 2021 earnings actually moved up to 166.47. The sectors that are going to lead in terms of earnings growth are the same. Industrials, consumer discretionary, materials, financials will all be at or in line or higher than the S&P. Tech and healthcare will grow at half the percentage of the S&P. Some economic data to close us out. We had a great week of economic data. Consumer sentiment beat expectations today, 81.2 versus 80.5. Consumer expectations also beat. Business inventories are rebuilding. That was good to see. That beat expectations. Retail sales crushed expectations, 1.9%. The consumer is strong. That's what we need versus 0.7. Core retail sales up. Everything on the consumer side is looking great. We had a big, crude inventories, big draw, 3.8 million barrels versus a small build last week of 500,000 barrels relative to expectations of negative 2.8. So we came in at negative 3.8. Again, exceeding expectations. Just wait, guys. I know that's an unsellable story right now, but you'll see. Continuing jobless claims. That's the most important number. Everyone was focused on the wrong number. Initial jobless claims. The key is continuing jobless claims. Dropped again down to 10.018 versus 10,700,000 estimates versus 11,180,000 last week. So that's the most important number. That continues to come down. By the way, looking at the China numbers here, the money supply increase, new loan growth. By the way, you need Wells Fargo if you're going to get loan growth. One of the biggest lenders, regulators, wake up, take off the asset cap. China is doing it. That's why they're recovering so fast. Okay, PPI was up. CPI was up. PPI was up. CPI, consumer inflation, met expectations and was flat with the last print slightly below expectations, so a little bit light on that. And China's exports were also good, which shows that up from last print 9.5, they were at 9.9% growth year on year. So that means global demand's coming back. Their imports were through the roof, which means their consumer is strong. And that's even before a vaccine or treatment. So this has been a chock full of data, VideoCast podcast. Hope you found it helpful. Feel free to share it with your friends. And we'll see you back next week, same time, same place. Thanks for tuning in.